Hi everyone, this is Professor Mihir Shah once again with one last video on international finance PGDFM semester 2. Now in this module we are going to learn about the last module of your international finance. Now just let me first make you all aware that in your exam from module 4 you will be having short notes. Okay, so you will be having 5 short notes out of which you will have to attempt any 4 in your exam. Now to start off with module 4, let us first just go through the syllabus. Okay, module 1 we have already done that in our very first video. Module 2 was also done in the next video. Module 3 was split in two parts. There were two videos on module 3. Okay, one was the theoretical part and the second video was the practical part. Now we will jump on to the fourth module. Now the fourth module consists of four topics. Okay, there are four lessons in module 4. Number 1 will have your international debt market, various instruments in international debt market, and the process of issuance of bonds. The second topic consists of depository receipts and the various types of depository receipts, that is the GDR, ADR and IDR. The third topic includes participatory notes in the Indian Forex market. And the last topic includes your introduction to the concept of Forex derivative, forward, futures, options and swap. Okay, the main or the learning outcomes of this particular video will be that after going through the video, you'll be able to understand what is a bond market, what is international bond markets, what are the various instruments of international bond markets, what is the issuance process of bonds, what are participatory notes, what are depository receipts, what are the various types of depository receipts, that is the GDR, ADR and IDR. Okay, what is Forex derivatives? What are future contract, forward contract, and lastly, what are options and swap? And thereafter, I will provide you all the question bank of your module 4. Okay, now the very first topic, okay, in your module 4 that we need to learn is what is a bond market? Now, the bond market is a financial market where participants buy and sell debt securities, usually in the form of bonds. So it is a financial market where the participant will buy and sell all types of debt securities, usually the bonds. The bond market primarily includes number 1, government issued securities, and second, corporate debt securities. Now let us go through the world's bond market. The total market value of the world's bond market are about 50% larger than the world's equity market. So they are 50% much bigger than the equity market of the world. Most issues are denominated in the US dollars, that is approximately 50%. The world's bond market, 50% of world bond market is denominated in US dollars. Japanese yen are the second, followed by the euro and the British pound sterling. Approximately 82% of outstanding bonds are domestic. Okay. Now let us learn what are international bonds. A bond issued in a country or currency other than that of the investor or broker is known as an international bond. They include euro bonds, which are issued in a foreign currency, foreign bonds, which are issued by a foreign government or corporation in the domestic market, and global bonds, which are issued in both domestic as well as international markets. So if you want to broaden up the types, so the international bond is further classified in three major types. Number one, domestic bonds. Second, euro bonds. And third, foreign bonds. Now, what are the main features of international bonds? Number one, it is a debt market. Second, it is a fundraising market. Third, it is fixed income instrument. Fourth, it is issued in foreign currency. And lastly, it channelizes the saving. So these are the five major features of international bond. That is, it is a debt market. It helps in fundraising. Okay, the instruments are all fixed income based. Okay, it includes foreign currency and it basically channelizes your saving. Okay, now as we said, bonds market are categorized in three parts. Out of which the first one is the domestic bond. Now, the bonds issued in the country and currency in which they are traded are basically known as the domestic bond. Unlike international bonds, domestic bonds are not subjected to currency risk because there is no fluctuation in the currency since bonds are issued, okay, in the same country and the currencies are also domestic currency. They usually carry less risk as the regulatory and taxation requirements are usually known to the investors in domestic bonds or at least to their brokers and accountants. Now, the various types of domestic bonds are public sector undertaking bonds, corporate bonds, financial institution and bank bonds. Then we have the emerging bond markets and lastly tax saving bonds. Okay, the next type of bonds we have is the euro bond. Now, what is a euro bond? A euro bond is a debt contract between a borrower and an investor, which records the borrower's obligation to pay interest and principal amount of the bond on a specified date. So here, under euro bond, okay, the borrower is obligated to pay the interest along with the principal amount on a specified date. In simple term, euro bonds are issued in a particular currency and sold in countries other than the denominated currency. For example, a firm issuing yen bonds outside Japan. When a Japanese firm issues yen bonds in the euro market is an example of a euro bond. The next type of bond that we have is the foreign bond. Now, foreign bonds are regulated by domestic market authorities and are usually given nicknames that refers to the domestic market in which they are being offered. A foreign bond allows an investor a measure of international diversification without the subjection to the risk of changes in relative currency values. In simple terms, foreign bonds are issued in a country in local currency by a foreign agent or the borrower. Okay, now let us learn various types of foreign bonds which are available in the world's market. We have the Yankee bonds. These are foreign bonds floated in USA. Next we have the Bulldog bonds. These are foreign bonds floated in UK. Next we have the Samurai and Shibosai bonds. Okay, the Samurai bonds are bonds. They are yen bond floated in Japan in open market, and the other one is the yen bond floated on private placement basis in Japan. The next we have the Dragon bonds. These are foreign bonds issued in local currency of the South Asian countries. Next, the Maple bonds. These are foreign bonds sold in Canada. Next, the Kangaroo bond. These are foreign bonds sold in Australia. Okay, now let us learn what are the various instruments of international bond markets. Okay, so here is a list of various instruments of international bond market. We have the straight fixed rate bonds, then we have the floating rate bonds, equity related bonds, zero coupon bonds, dual currency bonds, composite currency bonds, callable and puttable bonds. Now, let us try understanding one by one the various types of instruments. Okay, so the very first one was the straight fixed rate debt or the straight fixed rate bond. These are basically plain vanilla bonds with a specified coupon rate. Now, coupon rate is basically your interest rate and maturity and no options attached. So, it is a fixed rated bonds which are available. Now, since most of the euro bonds are bearer bonds, the coupon date tends to be annual rather than semi-annual. The vast majority of the new international bond offerings are straight fixed rate issues. Okay, the next is the floating rate bonds. It is just like an adjustable rate mortgage. It is common reference rates are 3 months and 6 months. These are the London interbank offered rate, linked variable interest rate bonds, wherein the interest rate is adjusted every 6 months. Now, since the floating rate notes reset every 6 or 12 months, the premium or discount is usually quite small as long as there is no change in the default risk. The next is the equity related bonds. Now here there are two types of equity related one. Number one is the convertible equity bonds. Here convertible bonds allow the holder to surrender his bond in exchange for a specified number of shares in the firm of the issuer. So these bonds convert into equity share after a specified period of time. In these category, they could be fully convertible or partly convertible bonds. So under equity related bond, the first type is a convertible bond, which allows the convertible bonds holder to convert their shares, convert the bonds into equity shares, either fully or partly. The second type is bond with equity warrants. Now these bonds allow the holder to keep his bond but still buy a specified number of shares in the firm of the issuer at a specified price. Okay, the next is the zero coupon bonds. Now these are also called the deep discount bonds. These bonds are issued as 0% interest rate bonds but at a discount to the face value. The bonds are paid back at face value on maturity. Thus, the discount on the face value actually represents the interest component. In the US, investors in zero owe tax on the imputed income represented by the increase in the present value each year, while in Japan, the gain is a tax-free capital gain. Next type of instrument is the dual currency bond. Now, these are bonds which are sold in one currency and the payment of interest or principal or both is done in another currency. In other words, they are straight fixed rate bonds with interest paid in one currency and principal in another currency. Japanese firms have been big issuers with coupons in yen and principal in dollars. It is a very good option for MNC financing a foreign subsidiary. Okay, an example can be that an Indian company may float a USD bond in US and pay the interest and principal back in the INR. Next, we have the composite currency bonds. It is denominated in a currency basket like the SDRs or the ECUs instead of a single currency. They are often called as the currency cocktail bonds. Typically, composite currency bonds are straight fixed rate debt. Okay, the next type we have is the callable bonds. Now this is a very important one. Callable bond, these are the bonds wherein the company reverses. These are the bonds wherein the company reserve the option to call back the bonds prior to the maturity but after the lock-in period. So under this, the company can call back, the bonds before the maturity but after the lock-in period. Such bonds are issued when, number one, it is a fixed rate bond and there is strong probability of softening of interest rates in future. And second, it is a floating rate bond and there is strong possibility of hardening of the interest rate in future. So based on these two reasons, the bonds can be called back. The next type is the puttable bond. These are bonds wherein the buyer has the option to sell back to company at any time after the lock-in period. So this is exactly vice versa of the callable bond. Such bonds are issued if the company does not enjoy a very good credit rating in the market to give some confidence to the investors. Okay, so with this, we complete basically the various instruments in international bond market. Okay, now let us learn the bond issue procedure. Now, the bonds are issued in the following process. Number one, the issuing company takes the approval of the board of director. So if a company wants to issue bonds, it will first need to take the approval of the board of directors. Second, the issuing company appoints a lead manager. Okay, so the issuing company will appoint a lead manager who will take the lead of issuing the bonds. Third, in consultation with the issue manager, the company appoints co-manager, underwriters, and brokers to the issues. So after appointment of lead manager, in consultation with the issue manager, the company appoints co-managers, the underwriters, and the brokers to the issue. Step number 4, the lead manager, he prepares the draft documents for the bond issue and the bond rate is decided. So the lead manager then will draft down the document, okay, for the issuing of bonds and they will decide the rate at which the bonds will be issued. Step number 5, the draft prospectus is discussed and is given final shape. So after the approval of the bond rate, after drafting the bond issue, okay, then they draft the prospectus and it is given the final shape. Step number 6, listing formalities are completed by the company and the issue manager. After the preparation of draft, okay, all the listing formalities will be completed by the company and the issue manager. Step number 7 will be the announcement of the issue is made. So after issue formalities are completed, okay, the company will announce that the issue has been made. Next, the investor's response is monitored. Okay, after the announcement of the issue is made, the company and the issue manager, okay, they will monitor the responses of the investors. Next, final after getting the response of the investor, after getting the money, okay, from the investor, the final bond issue is made to the investors. So here in this step, the bonds are actually issued to the investors. And lastly, a tombstone advertisement is published. It is basically in the form of Times advertisement, okay, detailing the response and money collected. So this was in simple, okay, the issuance procedure of bond. This, the topic related to international bond market, various types of bonds, okay, instruments related in international bond market and the procedure of issuance of bond comes to an end. Okay, now the next topic that we need to learn is the depository receipts. Now let us see what does this term depository receipt mean. Now, depository receipt, which is also known as DR, is a negotiable certificate of shares in foreign corporate institutions held by an investor stating his ownership from a country outside the market in which the shares are traded. In simple term, it means कि depository receipt is a negotiable certificate, okay, which is held by a foreign or an overseas investor of a country which is outside the country of the issued share. The shares issued by the company are held by depository banks, which is international banks which issues the receipt to the investors and distributes corporate benefit. So this entire work is done by the depository bank, okay, which is nothing but an international bank. So it issues depository receipts to the investors. Thus, a depository receipt can be described as derivative that gives the holder specific number of underlying shares of a foreign company. Now let us understand the depository receipt in a better way. Okay. Now we usually have a question ki what is depository receipt? Okay, what is it mechanism behind the working of depository receipt? How does it work? Okay, how is it different from shares and how is it same from shares? Okay, so let us take an example. Let's say there's an Indian company. Now if an Indian company wants to raise fund, it can basically do that by issuing of shares, that is public issue of shares. Now what if the company has already gone through IPO, it has publicly issued a shares and it has collected the amount. So we can say that the Indian company is already a listed company in India. It has already gone for public offer and still it requires now fund to be raised. Okay, so the Indian company, okay, is wanting more funds, so it wants to raise fund. Now it has decided that the public offer is already over, so you have got money from the Indian company or from the India itself, you got money from all the investors. It still requires more fund, so it has decided now, to raise fund from overseas. Okay, so in other term we can say that it want to raise fund. Let's say if we'll take an example of America. So let's say Indian company, it wants to raise fund, it wants funds from overseas, so it's raising fund basically from America. We have taken that kind of an example. Okay, now, okay, so Indian company has opted for an overseas fundraising from America. Now in America there came an investor who agreed to invest in Indian company, okay, and buy shares of Indian company. Now the question arises is, can the investor directly invest into Indian company or can the investor directly buy shares of Indian company? Now if we take the scenario of the Indian corporate market, many companies like HDFC, Infosys, etc., okay, have raised funds through depository receipt from United States of America. So now we need to learn ki how these Indian company sold their Indian shares to overseas people. Okay, by learning that procedure, we'll be able to explain what is a depository receipt. So now let's continue with the example that the Indian company, okay, it wants to sell its shares to a person overseas. Now for doing that, okay, company has to contact another company which is known as a domestic custodian. Now domestic custodian is similar to a company, okay, the main duty of a domestic custodian is that it will hold shares of the Indian company with it. So now all the paperwork, all the workings, all the formalities, okay, of the issue of shares will be held by domestic custodian. Okay, now the domestic custodian, he has a counterparty in USA. Now the counterparty is nothing but, let's say we can say like it has a collaborated company in USA. The domestic custodian has a collaborated company in USA. Okay, so now the domestic custodian will keep updating or will inform, okay, the collaborated or the counterparty company in USA, and that counterparty company in USA is known as the Overseas Depository Bank. So now the Indian company, okay, is want to sell its shares to an overseas person. So it will hire or it will give all its shares to the domestic custodian. Now the domestic custodian will hold all those shares and will update and inform the information about those shares to the overseas depository bank. Now, depository bank is just like a normal bank. In a normal bank, okay, it holds all the money. Depository bank basically holds all the shares in electronic form. So, as and when the Indian company informs or gives the share or gives the shares to be held to the custodian, the domestic custodian, it will update and inform the overseas depository bank, and hence the shares will be credited in the electronic form in the overseas depository bank. Now, if any Indian company wants to give shares, so therefore we can say that if any Indian company wants to give shares to a foreign company or a foreign investor, okay, then that company has to, number one, give his shares, all his shares to the domestic custodian. Then the domestic custodian will update and inform the overseas depository bank, who will credit all the the shares held, and thereafter, okay, it will inform and update the investor. And now this investor is nothing but the foreign investor. Okay, so the overseas depository bank, let's say overseas depository bank of USA, will inform the investor of USA about the credit of his shares. Now the overseas depository bank, it first of all will update and inform about the credit of the shares what he has got. On top of that, it will give an acknowledgement. Okay, it will give an acknowledgement, okay, to the foreign investors about the shares which are held by the overseas depository bank. Okay, and along with that acknowledgement, it will issue a receipt, and that receipt is known as the depository receipt. So depository receipt is just basic like a normal shares, okay, which are held by a foreign investor. So in India, if the shares are issued, it is called as shares. However, if those shares are issued outside India, it will be known as the depository receipt. Like the shares, the depository receipts can be bought and sold in the foreign stock exchange. Okay, so if the foreign investor wants to sell the share, just like the normal shares, how we trade off in our Indian foreign exchange market, Indian share market, they can also trade off normally in their normal stock exchange market. So this is the basic mechanism of depository receipt. So in simple term, if an Indian company wants to raise fund from overseas, okay, it will first issue shares to a domestic custodian, who will eventually update and inform the counterparty, that is the overseas depository bank, who will inform the investor, keep them updated, and issue them a receipt known as the depository receipt. Okay, so that was depository receipt in a very simple term. Okay, now the next thing that we need to learn is what are the various types of depository receipts. Now, broadly speaking, there are three types of depository receipts. Number one, the global depository receipt. Second, American depository receipt. And third is the Indian depository receipt. They are also known as the GDR, ADR, and IDR. Global depository receipt is nothing but it's a depository receipt whereby the Indian company, we take an example of the domestic as Indian and foreign country as, let's say, any let's say any country in the world, let's say an example of USA itself. So when an Indian company wants to raise fund from outside country, it will issue a receipt known as the Global Depository Receipt. ADR is basically where the Indian company raises fund only from United States of America, and Indian depository receipt is the vice versa. Here, the foreign company wants to raise fund from India. Now we'll try to understand all these three types in detail one by one. Okay, now the very first thing, the first type of depository receipt is the global depository receipt. Let us try to understand this in much detail. Now, the global depository receipt is a negotiable instrument and can be traded freely like any other security. So it's similar to like shares and any other security. It can be easily and freely traded. In the Indian context, a global depository receipt is an instrument issued abroad by an Indian company to raise funds in some foreign currency, and it is listed and traded on a foreign stock exchange. Now, the holder of GDR can at any time convert it into the number of shares it represents. The holders of GDRs do not carry any voting rights. They don't have any voting right, but only dividend and capital appreciation. But they get the benefit of dividend and capital appreciation. Now, many Indian companies such as Infosys, Reliance, Wipro, ICICI have raised money through issue of such GDRs. Now, let us understand global depository receipt with the help of the following example. Let's say the example that we had taken in depository receipt. Okay, we'll take the similar example and try to explain this term. So again, we have an Indian company. It wants to raise fund from abroad or from overseas. It has already issued public offer in India and have collected the funds. Now it wants more funds, so it wants more funds, want to raise more funds from the overseas market. So it hires or it contacts a domestic custodian which holds all the shares of local currency, that is in rupees. This domestic custodian will contact the counterparty, that is the overseas depository bank. Okay, now this overseas depository bank will issue depository receipt against the shares that we have already discussed earlier. Okay, now the overseas depository bank now informs the investors that those local shares of Indian company have been credited in their account in the overseas depository bank account. Now the investors are also given an acknowledgement about those shares held by them. Okay, and along with that they'll be given a receipt. Okay, the depository receipt will be denominated in US dollar, as we have taken an example of US. Now global depository receipt means US along with any other European nation, globally any kind of receipts available. Okay, so depository receipt will be denominated in US dollar, as we have taken the example of US in this particular graph. Okay, now that receipt what is given to the US investor is known as the global depository receipt. So it is similar, it is a part of depository receipt that we have already learned earlier. Okay, so global depository receipt is nothing but it is a receipt which will be given to the investor across the globe who wants to invest into India. The next type of depository receipt is the American depository receipt. Now let us see what does American depository receipt mean. The depository receipt issued by a company in the United States are known as the American depository receipts. The ADRs are bought and sold only in the American market, just like regular stock. So the only difference between ADR and GDR is that GDR comprises the entire globe. It includes the United States along with the European nation. However, ADR is only and purely bought and sold in the American market. It is similar to GDR except that it can be issued only to the American citizen. GDR can be issued to any citizen around the globe. However, ADR can only be issued to an American citizen and can be listed and trading on a stock exchange of USA. So ADR can only be given to an American, citizen, and it can be only listed and traded on a stock exchange of United States. However, GDR could be given to any person and it could be listed anywhere across the globe. Now let us again understand the example. Again, let us understand the American depository receipt with the help of the following example. Now the diagram mostly remains the same. There will only be one difference between GDR and ADR. So again, we start with a similar example that there is an Indian company who wants to raise funds. It has already raised fund through the public offer. Okay, now it wants to raise further funds from an overseas market. Okay, so for doing that, the Indian company contacts a domestic custodian, okay, who agrees to hold the shares of the local currency, that is in rupees. The domestic custodian, okay, contacts and updates and inform the overseas depository bank in USA, because American deposit receipt is only based in USA. Okay, the overseas depository bank, after getting the information and updation from the domestic custodian of India, okay, issues a receipt against those shares in United States of America. So it issues receipt against those shares in USA. Okay, thus it informs the investors and gives them an acknowledgement. Okay, it also gives them a depository receipt which is denominated in US dollars only. That receipt is nothing but the American depository receipt. So it was similar to your global depository receipt. The only difference was that here the issues receipt is against in USA and it is only denominated in US dollars. The next depository receipt is the Indian depository receipt. Now, just like an ADR or GDR, IDR is also similar to that. The only thing it is exact the opposite of them. Okay, the Indian depository receipt is a financial instrument denominated in Indian rupees in the form of depository receipt. So it is an Indian form of depository receipt. It is created by an Indian depository to enable a foreign company to raise funds from the Indian security market. So under the remaining two, the previous two what we had done, that was the GDR and ADR, there in those two, the Indian company wanted to raise funds from overseas. However, in Indian depository receipt is the vice versa. Here, the foreign country or the foreign company wants to raise funds from the Indian security market. According to SEBI guidelines, the IDRs are issued to the Indian resident in the same way as domestic shares are issued. The issuer company makes a public offer in India and the resident can bid in exactly the same format and method as they bid for the Indian shares. The Standard Chartered PIC was the first company that issued Indian depository receipt in Indian security market in June 2010. Now let us understand the Indian depository receipt with the help of the following example. Now the chart remains almost similar to ADR and GDR. However, it is the exact vice versa. So here the foreign company wants to raise fund. So it contacts the domestic custodian, okay, in which the shares are held by the domestic custodian of United States in dollar form. Okay, it informs and updates the Indian depository banks about the shares. Okay, the Indian depository bank issues receipt against these shares in INR or in rupees. Okay, and in rupees, and then they inform the investors and give them an acknowledgement about the shares they have been credited. The acknowledgement receipt is nothing but the depository receipt denominated now in rupees. This depository receipt is known as the Indian Depository Receipt. Okay. So with this, the topic on depository receipt comes to an end. We started off with what is depository receipt. We learned about the mechanism and the working of a depository receipt. Thereafter, we learned about the different types. There were three types of depository receipt. One is the global depository receipt known as the GDR. Next was American depository receipt, which is ADR. And third one was Indian depository receipt, which is IDR. And thereafter we learned in brief, in detail, okay, the various types of depository receipt. So with this, the topic relating to depository receipt comes to an end. Okay, now the next topic that we need to learn is known as the participatory notes, or in other term we can also call it as the P note. So let us see what is participatory notes. Now, participatory notes, which are also regarded as the P notes, are the instruments issued by the registered foreign institutional investors, or in other terms, they are also known as the FII'S. Now, the participatory notes are issued for the overseas investors who wants to invest in the stock market in India but without being registered under SEBI. So now let's take this example. Okay, there is Mr. X from US. Okay, he is an overseas investor. He wants to invest in Stock Exchange of India. However, he does not want to register under SEBI. Okay, in that case, the foreign institutional investor comes into the picture. Okay, and how does this particular participating note works? Let us read ahead and we'll get an idea out of that. They are they are used by the clients of the foreign institutional investors who do not wish to participate directly in the Indian stock market. So these investors, they basically don't want to directly invest into stock exchange. They want it through some broker, okay, or through some intermediaries. So here the foreign institution investor acts like an intermediary between the overseas funds or the overseas investors and the Indian stock exchange market. The participatory notes are also regarded as the offshore derivative instrument as they are used by the investor abroad but not within India. So in simple terms, participatory notes are nothing but, okay, those are basically funds which overseas investor want to invest in stock exchange of India. However, it does not do it directly. It does with the help of a foreign institutional investors. Now, let us take an example to understand participatory notes. Let's say Chris wants to get maximum return on the investment in quickest possible time. For this, Chris will have to find risky securities. Now, securities can be in the form of shares or bond in the third world countries, then invest the money from one country to another quickly depending on how the market moves. So if Chris wants to get maximum return at a very quick time, securities or shares or bonds are the only way where you can earn very quickly, but they are quite risky. Okay, in that case, he'll have to transfer the money from one country to another, and that also depends how fast the share market moves. Now, everyone knows that in India, no one can invest in share market without getting the PAN card and demat account. Other nations too have similar mechanism. But if Chris tries to get PAN card and demat account in each third world country, then his profit will decline given the cost of running branch office, staff salary, demat fees, etc. in each country. So if he wants to invest in India, okay, he cannot invest this directly without accessing the pen card or the demat. So he'll have to first open those two accounts. Only thereafter he can buy shares. However, by doing this, he will incur a lot of costs. So to take a shortcut, what does Chris do? Chris will contact some middleman who is already registered as an FII, okay, has pen card and demat in India. Let's take an example, HSBC Bank. So HSBC in this case is now the foreign investor, okay, or foreign investors institution, okay. It is registered in India, it has pen card and demat account in India. Chris will now give money to HSBC with the instructions to buy A, B, and C shares or bonds XYZ in whatever quantity he wants. So now these shares will be bought by HSBC and that will be the FII'S portfolio. Now HSBC buys Indian shares, okay, they'll be stored in demat account of HSBC itself and it won't be given to Tom. But then HSBC gives a receipt to Chris listing the shares or bonds purchased on his behalf and stored in HSBC's demat account. This receipt is called as the participatory note. So when an offshore investor wants to invest in India, okay, but does not wants to open or make a pen card or a demat account, does not want to register under SEBI, okay, he catches a middleman, that is the FII, who is already registered in India. They buy shares on behalf of the investor and they issue a receipt. That receipt is nothing but the P note or the participatory note. This receipt is called participatory note. Now, technically, it is also called as offshore derivative instrument. Now, observe those three words. Offshore means because foreigners owning something in India without coming to India or opening office in India. So that's the reason they use the word offshore. So here the foreign investor, he does not have anything in India, okay, but he still owes, the shares of India. Derivative because this receipt does not have value of its own. It derives its value from the market value of the shares and bonds held by HSBC. Today it may be worth, let's say, $1,000. However, tomorrow it can increase to $12,000 also, depending on how the price of Indian security move. Third, instrument. Now that is quite self-explanatory. This is one type of financial instrument to invest abroad. So that's the reason participating note is also called as offshore derivative instrument. Now the next question comes is, where is the profit in P notes or where is the profit in promissory notes? Now Chris has two options. Number one, wait and watch. If the price of the shares goes up, Chris can give a call to HSBC and tell him to sell them. HSBC returns the principal amount along with the profits to Chris after cutting commission. Now Chris returns the P note receipt to HSBC. So this is how one way profit can be earned under P note. The other way is it can sell this P notes receipt to any other foreigner, let's say Tony. Then Tony again has the same two options. Wait, number one, he can wait and watch and earn profit, or he can sell it to another person also. This is how the P note work, and this is the basic mechanism of the participatory note. Now let us go through the roles of foreign investors institutions in P note mechanism. Number one, the FIIs are international mutual funds or institution who basically invest money in Indian security markets. Second, they participate they participate directly in the securities market and their investment activities can be monitored effectively. The shares which they purchase are listed in their own names in the register of members of a company. So here the foreign investors details are not included. Okay, there's no need of mentioning the foreign investor detail. Or they only have to take the money from the foreign investor and then they can buy on their own name. The P note are traded on OTC basis through the issuing entity. The P note holder do not incur any capital gains tax as the P note issuing entity has still not sold the underlying security. Effectively, the market for P note is unregulated, whereas the investment by FIIs are regulated. Now let us go through various advantages and concerns of participatory notes. Number one, the participatory notes plays an important role in the Indian economy. A large proportion of the total investment are made through the participatory notes by the foreign institutional investors. So they play a very important role in the Indian economy. The instrument gained popularity as FIS to avoid the formalities of registering and to remain anonymous, started betting on stock through this route. However, their anonymous nature is also a cause of concern as these investors could be beyond the reach of the Indian regulators. Also, there is a view that it is being used in money laundering with wealthy Indians, like the promoters of company, using it to bring back unaccounted funds and to manipulate their stock prices. So this is one of the big concern of the participatory note. Now, for this reason, SEBI has taken a large number of steps to tighten the rules of P-note. Okay, so with this, the topic on participatory note comes to an end. So here we learned about what is participatory note. Okay, we saw the mechanism with the help of an example. How does participatory note works? Then what is the role of FIIs and what are the advantages and concerns of participatory note? Okay, now the next topic that we need to learn is the concept of Forex derivative. Now, under this topic, we'll be learning what is derivative, what are the uses of derivatives, and what are the various types of derivatives. Now, let us learn first what are derivatives. A derivative is a financial contract that derives its value from an underlying asset. So it is basically, a financial contract which is deriving a value from an underlying asset. Now, to understand this term underlying asset, okay, we will be taking up, a special topic as we go through this topic of derivative. We'll have a better idea about this term underlying asset. Now, under derivative, the buyer agrees to purchase the asset on a specific date at a specific price. Now, this is a very important point under derivative. Key the buyer agrees to purchase the underlying asset on a specific date. Now, the date can be any future date or the present date at a specific price. Okay. So, under derivative, okay, first of all, there has to be two parties. Secondly, the buyer agrees to purchase the asset at a specific rate and at a specific price. Now, when we are talking about the underlying assets, now what are these assets and what does it include? The assets include commodities. Commodities can be in the form of oil, gold, silver, then stocks, bonds, interest rate, and currency. So when we talk about underlying asset, we are covering up all the types of commodities, all kinds of stocks, all kinds of bonds, interest rates, and currencies. Now, the derivatives is basically used either for risk management, which is also termed as hedging, where you're trying to, lower your risk, or for speculation. Now, speculation is, another term used for betting. You are assuming that in future the price may increase or decrease. So based on your assumption, okay, you are trying to speculate the market, and based on that you can buy a particular asset at a specific date and at a specific price. So this is known as derivative. Now let us learn what are the various types of derivatives. Now, in the market, there are various types of derivative available, but among them, these four are the most important one. Number one is futures, second, forward, third, options, and fourth, the swaps. So, these are the four important types of derivatives that we need to learn, which are traded on regular basis in the market. Okay, now let us learn how are derivatives traded. So the financial derivatives in current scenario are traded on two terms. The first, the derivatives are traded on a term called as over the counter or OTC. Here the trader, the buyer and seller, okay, trade face to face. Now this is a bit riskier, okay, because it depends on person to person. Okay, so over the trade counter or over the counter trade of derivatives a bit more riskier. Okay, it can also be known as a direct trade because here the buyer and the seller face to face trade off. They are risky because it depends on person to person. That is the first type of trade which takes place under derivative or financial derivatives. The second trade off option is the exchange traded derivatives. Now, what is the meaning of exchange traded derivative? Now, here the derivatives are traded on, on a standardized platform such as the stock exchange. Now, this is a much lesser riskier than the over-the-counter trade. So these are the two types of financial derivatives available. One is the over-the-counter. Second one is the exchange traded derivative, or that is also known as the ETD. Now let us learn what are the various uses of derivatives. Number one, the risk aversion tool. One of the most important services provided by the derivative is to control, avoid, shift, and manage efficiently different types of risk through various strategies like hedging, ar- arbitraging, spreading, etc. Now again, derivatives is basically used for your risk management stuff. That is by hedging where you are trying to protect your risk. Arbitraging, again, similar concept. Spreading is again, the difference between the buying and selling. Okay. So derivative is basically used for your risk aversion tool. Next, prediction of future price. Derivative serves as barometer of the future trends in prices which result in the discovery of new prices both on the spot and futures market. So as a result, they assist in appropriate and superior allocation of resources in the society. Derivative helps basically in predicting not only the spot price but also the future price. Thus, it helps you to find out both the spot as well as future market. And okay, as a result, it assists in appropriate allocation of resources in the society. The next use of derivative is that it enhances liquidity. As we see that in derivatives trading, no immediate or full amount of transaction is required since most of them are based on margin trading. So under derivative, you're not going to actually pay the full amount, okay, costing of your asset, but you're basically trying to pay off the margin. So as a result, large number of traders, speculators, arbitrators, operators in such market or operates in such market. So derivative trading enhances the liquidity and it reduces the transaction cost in the market for the underlying asset. Since you're not going to pay, or since you're not going to immediately pay the full amount, okay, a large number of traders, speculators and arbitrage operate in such market, and it enhances much more liquidity and it reduces the transaction cost. The next use of derivative is that it assists the investors. The derivative assists the investors, traders, and managers of large pools of fund to devise such strategies so that they can make proper asset allocation, increase their yield, and achieve other investment goals. So this is a very important use of derivative, that it assists the investors to come up with such good strategies which are required for proper asset allocation so that they can increase their yield and achieve the investment goal. The next use is that it is like a catalyzed growth of financial market. The derivative trading encourages the competitive trading in the market, different risk taking preference of the market. The derivative trading encourages the competitive trading in the markets, different risk taking preference of the market operators like the speculators, hedgers, traders, arbitrators, etc., resulting in increase in trading volume in the country. So they also attract young investors, professional and other experts who will act as catalyst to the growth of financial market. So derivative, it encourages good competitive trading. So it result in huge volumes of trading in the country, and it can act as a catalyst to the growth of financial market. Okay, next, it brings perfection in the market. Lastly, it is observed that derivative trading develops the market towards complete markets. Now, let us learn various types of investors in derivative market. Now, in a broad sense, there are three types of investors in derivative market. Number one, they are known as the arbitrators. Now, what are arbitrators or who are they? This investor buys an asset at a cheaper rate from one market and sells it at a higher price in another market. Here the investor is taking the minimum risk. This price gap is very brief and it narrows down quickly, and the arbitrator might lose the opportunity. For example, if a share XYZ is trading at 100 rupees per share in cash market and rupees 102 in future market. So at spot rate it is 100 and in future market it is 102. So here the arbitrator would buy XYZ share at 100 rupees from the cash market and sell it at 102 in the future market, hence making rupees 2 profit per share. So here arbitrator is nothing but a person or an investor who buys cheaper, who buys an asset at a cheaper rate from one market and sell it at a higher price in another market, and thus earning the difference is nothing but the profit that he'll be earning. This is the first type of investor in derivative market. The next type is known as the hedger. Hedging is minimizing the risk or loss, as we have learned earlier also. In market, an investor who protects his investment from unfavorable price movement is called a hedger. So any person who tries to protect his investment, okay, from the volatility of the market, he is known as the hedger. So the hedger tries to limit the risk by buying put options, by paying a fixed amount known as premium. For example, an investor has a portfolio an investor has a portfolio an investor has a portfolio of rupees 5 lakhs. Now, to protect his portfolio from volatility, he can short index futures to make his portfolio beta neutral, or he can put or he can buy put option by paying a fixed cost known as premium. So hedger can use either short index futures or put option in order to save his investment from the volatility of the market. So this was the second type of investor in derivative market. Now the third type of investor in derivative market is known as the speculator. Now, who are speculators? They are the risk takers. They take high risk, expecting higher gain in short term. They buy stock with an expectation of they buy stock with an expectation of price rise and sells them at a high price level. So it is basically like a betting. You are expecting you're going to, you are expecting that the price of a particular asset will increase in a short period and you're trying to bet on that. This situation can make high gains for an investor, though it also has very high risk of losing your money. So if you're betting or if your assumption is not correct, if it goes the vice versa of what you're thinking, then you can go into heavy losses. For example, if a speculator feels that the price of ABC company is likely to fall in a few days due to some upcoming market developments, he would short sell the ABC company share in the derivative market. Now, if the stock price falls as expected, then he would make a good profit depending on his holding. So, depending upon how much holding he'll make profit in that case. However, if the stock price goes up against the expectation, then his loss would be equivalent. So these were the three different types of investors in derivative market. The one is the arbitrators, second are the hedgers, and third are the speculators. Okay, now let us learn what is futures contract, the very first type of derivative. Now, what is future contract? A future contract is an agreement between two parties to buy or sell an asset at a certain time in the future at a certain price. So now here under future contract, to remember that it is an agreement between two parties, so the buyer and the seller, to buy or sell an asset at a certain time in the future. So your future dated, you know, the contract has to be on some future date at a certain price. Now these are the three parameters on which future contract works. There is an agreement between two parties at certain future date at certain price. Now let us take an example. Let us say there is Mr. X. Now on 1st April 2020, okay, he agrees to buy shares of Reliance company, but he doesn't want to buy on the same day. Let's say he wants to buy it on a future date, that is 2nd April 2021. So let's say after 1 year, Mr. X decided now कि after 1 year he wants to buy shares of Reliance. Now the price of Reliance is rupees 40 as of now. As on 1st April 2020, okay, one share of Reliance cost rupees 40, but he wants to buy that in future, that is after 1 year he wants to buy that share. So now what happens here is Mr. X goes into a contract that is nothing but a future contract, whereby it will be stated in that key after 1 year, that is on 2nd April 2021, that will be written on the contract that on this particular date, on 2nd April 2021, Mr. X will buy shares of Reliance at the current market price, which is at the rate of 40. This is known as the future contract. Now, in this particular example, there are two parties. There is Mr. X and Reliance. So, the statement that it is an agreement between two parties to buy and sell, this is agreed at a certain time in future. This is a current date, but the contract will take place at a certain time in future. So that is 2nd April 2021. That is the future date at a certain price which is decided today itself. So this is known as the future contract. Now future contract are used basically to hedge against risk. So hedging is nothing but you're trying to again minimize your risk or speculate or bet on the price movement of the underlying asset. So in this case, we are taking the example of shares as your underlying asset. Now, the futures are standardized contracts traded on a centralized exchange. Now, standardized contract means that they are traded on stock exchange. It is not over the contract or over the counter trade. It is a standardized contract. Okay, standardized contracts means traded on stock exchange. They are less riskier than the over the trade. They are less riskier than over the counter trade, or less riskier than the OTC. Next, the future contract can be considered a sort of bet between the two parties. Now, yes, it is a kind of a bet. So the example that we had taken earlier, okay, Mr. X, he had betted. He thinks that the price of the shares of Reliance in future will increase. So he's betting on it, stating that today itself, whatever is the price, okay, after 1 year he's going to buy those shares at the same price. He is kind of betting, where he's assuming or speculating that in future, after 1 year, the price of Reliance shares will increase, thereby making the contract today itself and fixing the price at rupees 40. Okay, now let us take another example on future contract. Let's say there are let's say there are two people. Number one, Mr. Future, and the other one, Mr. Speculator. Now, Mr. Future already has some shares, let's say of Walmart, and let's say at the current date, let's say the date is 5th April 2020, he has Walmart shares which are costing rupees 75. Now, as we all know, the stock exchange is highly volatile. So he goes into a future contract with Mr. Speculator, stating him that he wants to sell the shares what he has of Walmart on 6th April 2021, that is after 1 year, but at a price which is the market price of today. That is at the current date market price he has made a contract. So Mr. Future agrees to sell his share what he already has to Mr. Speculator after 1 year, but the rate will be recorded of today's itself. Now let's say Mr. Future has 10,000 shares of Walmart, each share costing 75. Thus he has an amount of 7,50,000 invested in Walmart shares. Now he must have invested at, let's say, at a cheaper rate than 75. At present it is 75. Now he has decided this date of 6th April 2021. Let's say after doing a research that after 1 year he'll be requiring this 7,50,000 amount for his future reference. Okay, let's say he'll require that amount. Now after 1 year he does not know what will be the market situation. So he agreed to go into a future contract with Mr. Speculator, stating that after 1 year, okay, he'll be selling all his shares to him, costing 7,50,000. Mr. Speculator agreed on the deal. This is known as the future contract. Now, this is one aspect of the contract. Now, let's say we come to the date, future date, that is on 6th April 2021. Now, let's say on this particular date, the market value of the share rose to 85 rupees a share. Now, the contract was already made stating that after 1 year, okay, the speculator will pay Mr. Future a price of 75 per share. So here the market value of share, which is 85, will not be considered. So here the amount that Mr. Speculator will be paying the Mr. Future will be rupees 75. Now in this particular example, Mr. Speculator becomes the winner as he has bought the future contract at a discount rate. Thus here Mr. Future becomes a loser, goes into a loss. Now this is one scenario. The vice versa can also be there. Let's say the market value of share rather than become 85, let's say it became 65. So in that case, Mr. Speculator would be on the losing side and Mr. Future would have been on the winning side. So this was the example of future contract and how it actually works. Now let us learn what are the features of future contract. Number one, financial futures like commodity futures are contracts to buy or sell financial aspect at a future date at a specified price. Now this you already learned as per the definition. Next, future contracts are traded on organized future exchanges, that is on stock exchanges. Future contracts are standardized contract in terms of quantity, quality, and amount. The margin money is required to be deposited by the buyer or seller in form of cash or security. So here, the contract is going to be made in future, but here you'll have to, deposit the margin money as security. Now, in case of future contracts, there is a diary of opening and closing of position known as marked to market. The price difference every day are settled through the exchange clearing house. These were the various features of future contract. Okay, the next type of derivative that we need to learn is the forward contract. Now, what is forward contract? A forward contract is a non-standardized contract between two parties to buy or to sell an asset at a specified future time at a price agreed upon today. Now, this is similar to your future contract, but here mostly the contract takes place between arbitrators. Now, arbitrator is a person who buys from one and sell it in to someone else and thereby earning a profit. Let's say the example ki here according to this Mr. X, or let's say the first person sells an underlying asset costing 75 to second person, whereby the second person will sell it to someone else at rupees 80. Okay, so this forward contract basically is done between the arbitrators. Okay, the only difference is it is done over the counter. So forward contract is a non-standardized contract. So it is not traded on stock exchange, but it is traded over the counter. Rest all the features remain similar to the future contract. The difference, so here the key difference being that unlike futures, forward contract or forwards are not traded on exchange. Rather than that, they are only traded over the counter. So that's the only difference between the future contract and the forward contract. Forwards are used basically to hedge risk in commodities. Again, when we talk about commodity, it can be oil, gold, silver, etc. Interest rates, exchange rates, or even equities. Now let us learn what are the features of forward contract. Number one, bilateral. Number one, bilateral. Forward contracts are bilateral contracts and hence they are exposed to counterparty risk. Counterparty risk meaning here there are two parties involved. So if any one of them makes a default, the other one will suffer. It is more risky than futures. There is a risk of non-performance of obligation by either of the party. So these are riskier than future contract. Customized contract. Each contract is custom designed and hence is unique in terms of contract size, the expiration date and the type, the asset type and the quality, etc. The next feature is that it is long and the short position. In forward contract, one of the parties take a long position by agreeing to buy the asset at a certain specified future date. On the other side, the other party assumes a short position by agreeing to sell the same asset at the same date for some specified price. So here buying of forward contract is known as long position and selling is known as the short position. Next, delivery price. Now this is a very important point under the features of forward contract. The specified price in a forward contract is referred to as the delivery price. The forward price for a particular forward contract at a particular time is the delivery price that would apply if the contract were entered into at that time. Now it is very important to differentiate between the forward price and the delivery price. Both are equal at the time the contract is entered into. However, as the time passes, the forward price is likely to change whereas the delivery price remains the same. So let's say Mr. X goes into a contract with Mr. Y. Let's say as of now or as the spot rate of conversion was, let's say, rupees 40. Okay. Let's say Mr. X goes with a contract with Mr. Y. The current rate of a product is, let's say, rupees 50. After 1 year or after 1 month, Mr. X agrees to pay Mr. Y for for particular asset but at the rate of 50. So at the time of contract, the delivery price and the forward price both are same, but however as time goes on, okay, as the time goes on, the forward price may change. However, the delivery price, that is the price at which the contract was set, that will remain the same. The next feature is that it is an synthetic asset. In forward contract, derivative assets can often be contracted from the combination of underlying assets. Such assets are known as the synthetic assets in the forward market. Next, pricing of arbitrage based forward pricing. In forward contract, covered parity or cost of carry relations are relation between the prices of forward and the underlying assets. Such relation further assist in determining the arbitrage based forward asset price. These were the various features of forward contract. Okay, the next topic or the next type of derivative that we need to learn is the swap. Now, what is swap? A swap is most often a contract between two parties agreeing to trade loan terms. Okay. Now let us understand this with the following example. Let's say there are two person, or before that, let's say first we are trying to understand the swap based on loan or term loan. Okay. Now under term loan, the word swap is used against the interest rates swap. Now, under loan, there are, let's take an example of home loan. Now, there are various types of loan, but let us, to explain this concept of swap, let us take an example of home loan. Now, under home loan, there are two types of interest payable. One, flexible interest, or it is also known as a variable interest. And second, we have the fixed interest rate loan. So, home loan can be taken on flexible rate or on fixed rate. Okay. Now let's take an example. There are two parties, Mr. X and Mr. Y. Mr. X has taken a home loan of, let's say, 50 lakhs rupees from Axis Bank, and he has taken a loan on fixed interest. Whereas Mr. Y has taken loan from SBI Bank. Again, amount is 50 lakhs, but he has taken on flexible rate. Now, in future, let's say after couple of months, after a year, Mr. X came to know that the interest rates are falling. So he decided that to convert his fixed rate interest into flexible interest. Whereas Mr. Y, who has taken on flexible, he came to know that the rates are fluctuating a lot and the rate can increase in future. Thus he tried to, he wants to invest or wants to change his interest rate to into fixed rate. So here Mr. X and Mr. Y can go into a contract, okay, to swap their interest rate. Mr. X, who was going under fixed interest rate, okay, wants to swap it with flexible rate, whereas Mr. Y was going into a flexible, want to swap his interest rate with fixed interest rate. This type of contract is known as the swap contract. So one might use an interest rate swap to switch from variable interest rate loan to a fixed interest rate loan or vice versa. So this is what we explain with the help of this example. If a person might seek to switch their variable interest rate loan with someone else who has a loan with a fixed interest rate that is otherwise similar. So they say now in this same example, if Mr. X wants to, switch his fixed interest rate with a flexible interest rate and Mr. Y want to switch between flexible to fixed, in that case is on, this case is only applicable if the, the type of loan is similar and the amount of the loan is similar. Okay, that is the loan amount or the type of loan should be equal. Only then they can go for swap. The loan will remain in the original holder's name. The contract mandates that each party will make payment towards the other's loan at a mutually agreed upon rate. So the loan amount remains same, the loan original holder's name remains same. However, in this case, Mr. X will now pay Mr. Y's interest and Mr. Y will now pay Mr. X's interest. Now, a swap can be risky because if one party defaults or goes bankrupt, the other will be forced back into their original loan. So let's say between Mr. X and Y, if Mr. X goes into bankruptcy, okay, the contract ends there itself and Mr. Y will start with his original interest rate. Swap can be made using, now there are different types of swaps. Okay, the swaps can be made using the interest rate that I already explained with the previous example. It can also be done through currencies or commodities. Now, in case of interest rate swap, the exchange may be of cash flow, arising from fixed or floating interest rate. This we already learned through the previous example. Now, under interest rate, you can swap between fixed and floating interest rate. Under equity swap, it involves the exchange of cash flows from returns of stocks index portfolios. So, under equity, swapping is done between the exchange of cash flows from return of stocks index portfolio. The currency swaps have basis cash flow exchange of foreign currencies and their fluctuating prices because of varying rates. Next, the currency swap have basic cash flow exchange of foreign currencies and their fluctuating prices. So, under currency, swapping takes place between your domestic currency and foreign currency because of the fluctuating prices. Now, because of varying rates of interest, pricing of different currencies and stock return among different market of the world. So, swapping takes place because of these all factors. Okay, now let us learn the various features of swap. Number one, counterparties. Financial swap involves the agreement between two or more parties to exchange cash flows or the parties interested in exchanging the liabilities. Second, facilitators. The amount of cash flow exchange between parties is huge and also the process is complex. Therefore, to facilitate it, therefore, to facilitate the transaction, an intermediary comes into the picture which brings different parties together for big deals. Now, these may be the brokers whose objective is to initiate the counterparties to finalize the swap deals. So under swap, there'll always be a broker who will be involving and who will try to bring the parties into the swapping contract. Next is the cash flow. The present value of future cash flows are estimated by the counterparties before entering into the contract. The next feature is that there is less documentation. Okay, less documentation is required in case of swap deals because the deals are based on the needs of the parties, therefore fewer complexes and less risk consumed. The next feature is that transaction cost. Okay, swap deal usually generates very less percentage of transaction cost as it involves in. Okay, next is the transaction cost. In a swap deal, the percentage of transaction cost is very minimal. Next, it benefits both the parties. The swap agreement will be attractive only when parties get benefits of these agreements. Last, default risk. Under swap, the default risk is higher than the options and futures because the parties may default the payment. Okay, so these were the various features of swap. Now, the next type of derivative that we need to learn is the options. Now, let us see what is the meaning of option. An option is similar to a futures contract in that it is an agreement between two parties granting one the opportunity to buy or sell a security from or to the other party at a predetermined future date. So again here it is an agreement between two parties granting one the opportunity to buy or sell a security from or to the other party at a predetermined future date. The key difference between options and future is that option simply gives the buyer the option to either buy or sell the asset at a certain price and date. Now, let us see what are the various types of options. Number one, call options. Calls gives the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price on or before a given future date. So the very first type of option is called as the call option, where the buyer gets the right but not the obligation to buy the given quantity of an asset at a given price on or before the given future date. That's the very first type of option. The second is called the put option. Here it is the vice versa. Put option gives the buyer the right but not the obligation to sell a given quantity of underlying asset at a given price on or before a given future date. All the options contract are settled in cash. Now, further, the options are classified based on the exercise. At present, the exercise styles can be either European options or American options. Now, what are American options? American options are options contracts that can be exercised at any time up to the expiration date. So, up to the expiration date, okay, you can go into the contract and exercise it as many times. Options are, or the American options are, options on individual securities available at NSEs are American type option. So on individual security, if option is available at NSE, then they are American types of option. The next was the European option. Now, European options are options that can be exercised only on the expiration date. So only on the expiration date in future date or on the future date, European options can be exercised. Okay, unlike the American option that it can be any time, okay, up to the expiration date. Now all the index options traded at NSE are European options. Now let us learn the various features of option. Number one, it is a contract. Option is an agreement to buy or sell an asset obligatory on the parties. Second is premium. In case of option, a premium in cash is to be paid by one party, that is a buyer, to the other party, that is the seller. So we don't say a cash has been paid, but premium has to be paid under option. Payoff from an option in case of buyer is the loss in option price and the maximum profit a seller can have in the option price. Okay, from the option point of view, payoff means in case of a buyer it is the loss in option price and the maximum profit a seller can have in the option price. So payoff is nothing but the maximum loss a person can make and a maximum profit a person can make under option. The next feature is the holder and writer. Holder of an option is the buyer while the writer is known as the seller of the option. The writer grants the holder a right to buy or sell a particular underlying asset in exchange for a certain money for the obligation taken by him in the option contract. Next is the exercise price. There is call strike price or exercise price at which the option holder, that is the buyer, who calls or sells, that is the put, an underlying asset. So the exercise price can be either the buy or it can be either the call or the put option. Variety of underlying assets. The underlying asset traded as option may be variety of instruments such as the commodities, metals, stocks, stock indices, currencies, etc. These were the various features of option, and with this we come to the end of derivative and the various types of derivatives. And with that we come to the end of the syllabus of the international finance. Okay, I want to thank each and every one of you all for viewing the videos. Okay, it was a great experience. Okay, so with this we conclude the subject international finance. I hope you all do very well in your examination. Okay, so but before ending I will provide you all the question bank for your module 4. This is the question bank of module 4. It will be purely based on short notes. So in the exam, you will be getting 5 questions, out of which you all will have to attempt any 4. Okay. So this is the question bank. You can have a look at it. Okay, for further queries, you can email me or WhatsApp me. Okay. Thank you. If you like the video, you can subscribe to the channel and press the bell icon for further notification.